All right, for more on the markets, let's go to Morgan Stanley Investment Management co-CIO of Global Balanced Funds, Jim Caron. Jim, good to see you, sir. Let's start with what we saw from inflation, the print this morning. What's your big picture takeaway from the numbers?
So thank you, and thanks for having me on your show. Look, I think the big picture takeaway is that there was something in this number for everyone. But I think where the markets ultimately settled on this whole thing was that inflation is coming down, but it's not coming down fast enough. And this raises questions of whether or not the Fed needs to continue to stay tight. Now, look, the markets are pricing in at this point that the Fed's going to 5.25%. They've even taken out most of the rate cuts that were priced in for this year, with maybe one rate cut towards the end of the year, and not even. So, look, I would say that the big takeaway here is that given that there's been such a big shift in Fed narrative and Fed expectations, that the risk markets, equity markets, and everything else has actually taken it kind of in stride, which is maybe emblematic of the fact that the economy might be a little stronger or hotter than what some people were thinking previously.
Yeah, it's really interesting, isn't it, Jim? I mean, I've said it earlier, it's kind of an economic Rorschach test because it's just what you want to see it. Some see a bat and others see a butterfly in these numbers. What do you make of the market reaction, or rather lack thereof, today?
Yeah, so I think it's actually more or less constructive. The fact that we got a number today that I think most people would agree probably disappointed, meaning that inflation didn't come down enough. Inflation didn't come down to where it needed to go to. So, with that in mind, and, certainly 10-year Treasury yields, 2-year Treasury yields, all bond yields are rising. And you would think that with this kind of a move in the market in terms of interest rates rising, that equities would suffer a bit more. And the fact of the matter is that they did go down maybe a little bit, but I don't think it's anything dramatic. So I think equity investors are taking this in stride. They're looking at potentially the cuts to earnings or the weakness in earnings as something that they're willing to look through and think of it more as a correction. Because look, at the end of the day, what's really happening here is that we're shifting the narrative from hard landing to soft landing to potentially no landing. And as we make that transition, this is actually a positive for equity prices and for everything else, because people just aren't positioned that way.